Hey everybody, it's Ryan with Propelio. Today we're going to be talking about market trends, market analysis, basically just understanding if your market is going up, if it's going down, going side to side, all those things. It's going to be an open discussion. We've got a good friend of mine, Waldrop, who's our resident economist, and we've got Casey, who's our resident data nerd. It's going to be a good show. Stick around, drop those comments, give us a like, give us a subscribe, all those things, and we'll be right back.
Propelio TV is sponsored by Noble Mortgage and Investments, Batch Skip Tracing, Think Multifamily, CreativeCashflow.com, and Life and Air.
Hey everybody, thanks for watching today's show. Today's going to be interesting because I've known Tyler for almost 20 years, and he's very smart, and we're talking about hot or not, how to read the market.
Hot or not? Let's figure it out.
I love it. I love that I'm the hot.
I'm laughing so hard right now because the conversations pre-recording are fantastic and data related. So data's fun.
Data related.
Yes, we were talking about, so that app, Hot or Not, used to have a data analysis thing that Ryan can go into extreme detail about, Ryan.
Yes. Unfortunately, that's not what we're talking about today. So, first of all, when we're talking about market trends, there's a huge difference between what a market is. So I think we should start with like defining what a market is, because it could be anywhere from just the singular house to the neighborhood to the city to the nation to the country to the globe. So what are we going to be talking about?
So, I mean, just in general, and y'all can come up with something more beautiful if you'd like. But I'd say when we're talking about the general real estate market, we're just talking about the overall economic state of real estate, and that is largely based on supply and demand.
In the United States?
Anywhere. It could be anywhere. There's other indicators, but we're going to be focusing on the U.S. market for obvious reasons because we're here.
Right, and as an investor, you need to probably focus on your hyper-local market or sub-markets, like you're saying, your neighborhood, anything to get the indicators that are going to matter to you.
Yeah.
Right. And a quick example of that is like in 2008 when the whole world was crashing around. Like you've got areas like South Lake that barely saw a dent.
Right, exactly. So I'd say it's really important to look at kind of your more macro, larger, overarching indicators that are going to happen. But at the end of the day, we all know that a dip for somebody can be a really great market for somebody else. So a few other things I would just throw into that mix would just be kind of your location, your niche, and your type of real estate that you're doing, because those can all help you pivot into different areas of real estate and keep you insulated.
I'm glad you brought that up, because the conversation we're having today, there's no value judgment placed on the high or the low, because like everything in real estate, it depends. Like if you have a good market strategy, you can make a killing when the market dies, or you can lose your ass when it goes up. So it just depends on what your strategies are. So I don't feel like we're putting a value judgment on the ups, the downs. It's just is what it is.
Yeah, we really want to kind of have a conversation with Tyler, with us, kind of our kind of joint knowledge, and just be able to give you guys some indicators to look at, because let's be honest, how many people do you hear chattering about the market that have opinions of where it's going, and it's like completely different perspectives.
All that this is doing, again, never fear the data. The data is always going to be there to help you. Is it data or data? Let's just determine that right now. I mean, seriously, is it data or is it data?
It's going to be about.
What do we call it?
You
say data.
Do I say data? I say data, I guess.
Okay, so then it's data.
It is data.
So we'll say data. So anyway, the data is not something to be feared. The data is something that the more you know, knowledge is power.
Right.
For investors, specifically, if the market goes down, people start getting into pre-foreclosures. What is that? Pre-foreclosure list. I mean, you've got, so this is just letting you know what could happen or what is likely to happen. Here are the indicators to look for, and we've all seen them. So
and real quick, and I know we don't really talk about our CVs much. Can you give us like a 30 to 45 second elevator pitch of your background, what you've studied in terms of economics? That way people know, maybe Tyler is as smart as Ryan says he is.
I grew up in Alabama, went to... No, exactly.
Is there a buzzer?
Start over. Went to school first at Pepperdine, then at Yale, then graduated from SMU with a degree in economics. And first wanted to be a psychologist, but I thought, well, changing one person at a time is not as effective as being able to change entire groups of people through incentives and disincentives. That's what economics are, and markets, people, behavior markets are affected and are able to be changed by incentives and disincentives. And again, both of you would agree, that's all a market is people's
Absolutely.
behavior in response to other to factors that are implemented upon them. And so the housing market prices change based on supply and demand.
And on top of that, you do have several rental properties and several commercial properties
right.
and land itself. So real
Right.
estate investor.
He's
economist,
legit,
boom.
y'all.
Well, I mean,
He's
it wouldn't
legit.
matter.
It doesn't
Data's data. I don't care if somebody came in here that's like, I'm homeless and I have a PhD in economics. I'd be like, okay, tell me.
Right.
But I mean, you know what I mean?
Yeah.
It doesn't. It's just the market's the market, and the indicators are the indicators. That's what we're wanting everyone to look out for.
Awesome.
So, what are ones, Casey, say that you look out for, or something that you see or you have seen or noticed to be true?
So, you know, I'll be really honest. I've always been a higher level macro type of analyst when I look at things. And then I can identify kind of where those gaps are and dig in a little bit deeper. So we talked about kind of some leading indicators, and I think the top 3 that are a little unconventional that maybe not a lot of people are tracking is the number of building permits that are being issued
Right.
in any given market. The housing starts, and that means if a permit's been issued, the actual building of the house has started. The third would be actual new home sales. When you put all of 3 of those together, as hopefully we have some cool slides to show.
We do.
You're gonna see that that's actually a leading indicator of other things like the stock market, commodity prices, prices of homes, and things like that.
Absolutely.
Right?
Yeah.
And to add to that, and just to subtly pitch Pam and Shelby's show, commercial real estate is, that's good, but when I hear number of building permits, that seems like a lot of homework. You know, like everything
Super
you just
easy to
said.
find.
But I'm just saying that seems like work to find that information.
Guess how you find it?
But just time out. Let me get to my point first.
We reject it.
You reject my permit. No, but like if a McDonald's is coming in, or just find other like commercial assets or properties are coming to town that would make sense that come with a boom in an area. Y'all threw me. I had a point. Hopefully I made it.
No, you had a point. You said it's hard to find that data. Where do you find that data? And we
Well,
said
the city government.
Google it.
Google it.
Literally, Google it, and you will find a source for it. If you want to then bookmark it, if it's something important, if you
Yeah.
want to get, I don't know, do you like to do a quarterly view, or what kind of view do you like?
It's not something I do frequently, but
Right.
you can get this data monthly by census.gov. If you just go to business sections, and quite frankly, there's probably a lot of analysts out there that already have the long term of this data put out if you Google it.
Absolutely.
And if you just wanted to go in your market and see what kind of is more relevant today, do you see that number is higher or lower? That's a really quick way to just see.
And real quick, I would like to do a side tangent of why this is a relevant conversation. Because first of all, you should never be buying a property specifically on speculation of appreciation. You should be buying it because it's a good deal. But the appreciation side helps. But also, if you know like a landslide is coming, by watching some of these indicators, maybe it's a good time to hold off and not buy.
Well, the one thing too, and you're saying buy it as a good deal, and as always, a good deal depends on what you're trying to do.
Correct.
Most investors, I think at this point, or from what I'm seeing, are understanding that when you're getting into investing, it's not about making cash flow. Yes, cash flow is important up front, but that's creating a job. If you're wanting to get in for long-term wealth and hold, it's just like a stock. You really have to be in for the long haul, and you really have to have a strategy and understand what you're doing. And all this data does, all this are tools to really help you understand by the end of next year, what our price is going to be. If that's your goal. If your goal is to buy now, sell in 3 months, then you really need to do a 3-month analysis and figure out what's going on, because you need to know through your holding cost, is the price of that house going to drop? So is it going to be effective? And that's kind of just what it is. We're just trying to make you a smart investor.
And look what happened in even December, January, February of this year, right? We can all very easily put a blanket statement over that and say, oh, it's just the time of year, it's common in the cycle. But no, there were actual people who were fearful because they thought we were at a peak for so long that they just assumed due to cycles, and they just kind of felt like the market and everybody stalled. I know some private money right now that are freaking out about buying, or at least a month or two ago, because they were just hearing the chatter. And so if you're just going off the chatter, you might stop in buying, and then guess what? I lose a lot of buyers because I'm assuming everyone's buying right now, and then I might not be able to wholesale that deal, and I might have to say I have to keep it and turn it into a rental.
So there's two concepts that forgive me if everybody knows this, but like I didn't know it until, I've known about it. But anyway, anecdotal, empirical. Like the feeling of something is anecdotal and whatever.
Anecdotal.
Thank you. And empirical is like it's on paper, it's numbers. So like the feeling of it, yeah, there's a feeling out there, but is it data driven?
And something that I'll put to that, and this is a little bit of my background, is that I come from a media analyst or information analyst type of background, in that we have actually proven, guys, there's a lot of stuff out there that proves that how you talk about things, how things are covered in media, whether it be social, your newscast, locally, all of that is going to affect your thoughts and behavior. This is absolutely proven. So all of that stuff combined can actually change markets.
Which is why you should subscribe, hit the like button, and drop a comment on this video.
Well, yeah, and like you were saying, that's classic bank run. When someone gets a fear that they're not going to be able to get their money out of the bank, and everyone starts getting their money out of the bank, well, then you've caused the bank run. The same thing as that's why Ponzi schemes collapse, because someone panics, they go in. So there's no actual empirical evidence that points to the reason that a bank is going to fail or that a Ponzi scheme is going to fail. It's a feeling, a post in the Facebook groups, a chatter that you've been hearing, and as you say, there are ways to empirically measure that. I'm not sure that's an interesting topic, but yes, if you can see how, unfortunately, it's almost like trials now. Even criminal trials are trial by Twitter. It's it's true. So
luckily, in the real estate world, none of us are really on Twitter, so we're good.
Well,
Apparently,
you could be. Well,
I didn't even know that was still a thing.
Well, Twitter, no, they just showed the other day about the social media things, and not one of them mentioned Twitter. I was like, man, that's completely
crazy.
absent. But yeah, so if we want to go, do we want to go into the indicators a little bit now?
So yes, so that's kind of a good roundabout back to the indicators, because guys, it's really hard sometimes. You're like, oh, I don't know what causes what. Well, we can show you some past data that shows that these leading indicators, the ones I mentioned, the three, what do we say, building permits, housing starts, and new home sales, are, I have the clicker.
It's on the thing there.
I don't even know how to work. I don't even know how to work
the forward button.
Yeah.
There we go. Boom. Is that showing? Okay, so that's showing. So yeah. So the leading indicators, Casey, you were saying, go ahead.
So yeah, so we were saying, so like we mentioned, and you can get this off of census.gov, it comes out monthly. So if you want to do it monthly and keep an ongoing chart, that's something I would do, but it's just totally up to you guys. You can find all three of these things, and what it does is you can see on this chart here, which I know a lot of people's eyes are probably glazing over. But you explained this really well when we were looking at. I do too.
Yes, graphs are so good if you can read them.
With data.
Well, just think of it as a painting.
Art with data.
Well, that's what it is. Look, so what it shows is this has on here basically the permit, the number of permits issued are going to predict the number of housing starts. The number of housing starts is going to predict the number of sales. So all of these on here, you've got the permits are the yellow line, the starts are the dark blue line. I'm sorry, the permits
are gray, starts are blue, yellow is sales, and red is house pricing index.
And you can see on this that house pricing lags behind the others. So it's the shape of the other ones, but a little bit after the other ones hit that shape.
Exactly.
So they're leading indicators. So when the price starts going up or down, it's because the other indicators have determined that that's what's going to happen. It's sort of following.
Exactly. So basically, when any of those three indicators start trending in one direction or another, you're going to see that housing price start to stall and go and follow it. That's what you see in 2007.
Yeah, and on this one right here, the graph that you can see right here, the really big, like, bam, the crash, that was before actual October 8th, 2008. That was before. So if you had started at the end of 2006, it really started to show that building permits really started to, not slow, they started to crash.
That's a significant lag right there.
Yeah, that's a significant lag, because you could see, you could see right there during almost the middle part of that, when you look at the top blue lines, almost the middle of that complete downward slope, that would be like a black diamond. Would that be like a double black diamond skiing slope?
I
Probably.
guess.
Anyway,
Maybe on my
that
skill
down,
level.
the prices were still going up and actually had hit a peak at that point. Midway when that was crashing, midway when all of the other indicators were crashing.
So if you weren't watching these indicators, you might think everything's rosy, everything's good, and all of a sudden,
if you were just looking at house prices.
That's what I'm saying.
Right.
If you were only looking at that and not these other indicators, and you bought at the peak,
But what's important about this too, and Casey, you've made that point a lot, is it's not just looking at one or two of the indicators.
You
It's
have to
looking
overlay.
at them overlaid. It's looking at the data together because it's going to show you where these things cross. And right there at that point, I mean, if you had been at that, I can't tell where that goes down to, but let's just say that's August 2007.
right.
You would have been like, uh-oh, what's happening? Now, it's not determinative. It doesn't mean that that's what's going to happen exactly, but it's pretty much what's going to happen. You know, so I mean, again, it's taking all these indicators, the building permits, the housing starts, the new house sales, that are a feedback loop, overlaying that house price and seeing, okay, what's going on?
Exactly. And this can look different. You can do this on a larger scale across the U.S.
Yeah.
Or you can really look at your own markets, which shall I go on?
Yeah,
Do
you can.
have-
Go. I don't remember what the next
So
slide is, but yes.
just to give you an idea, Tyler did this really quickly to just pull out building permits.
Yeah.
Goodness, building permits for a few of our bigger metros here in Texas.
Well, and some other ones
and
too
a
that I thought
few
were
outliers
interesting.
here. So why don't
Is Anniston
Well, because
really
I put where
zero?
I'm from. I put where,
That's
yeah.
what I
That literally the
saw.
bottom one is the city where I grew up, and it has to be like an MSA of over 100,000. So it's on there. It's on there. It's
so
embarrassing.
he got out. He's like,
So,
I'm out.
Yeah, a lot of other people did too.
I just want to side tangent for 2 seconds, only because I've known him for so long, and every conversation revolves into how Alabama's better, but then
No.
equally turns into how Anniston's the worst city in the country.
No, Alabama football is better. Not than Clemson this year, but
Right.
Alabama.
Anyway, moving on.
Moving on. So basically what this shows, I picked some big MSAs. I picked the big ones in Texas. Dallas-Fort Worth, total building permits, 4,250. And then what I thought was interesting is I have highlighted in blue and then in green, single family, and then the one in green highlights kind of all multifamily. And then at the end, I've got the percentage of building permits that are single family, percentage that are multifamily. And Casey, we were talking about this too. That also tells you something about a market. That tells you a lot about a market. So Houston had the most building permits in the United States at 6,000, and it's right at 50-50, 50% single family, 50% multifamily. Mm-hmm. So Dallas right now is at 60-40, about 60-40. 60 single family, 40% multifamily. Mm-hmm. To me, and this is my opinion, and whatever, take it for what it's worth. I think when you move down on the list, you have the next highlighted one, which is Los Angeles and then New York. You see the numbers there, but the percentage of single family to multifamily. In Los Angeles, it's 21% single family, 79% multifamily. In New York, 17% single family, 83% multifamily. Now, Ryan, I'm just going to ask you, what would that tell you that New York and LA are
Congested.
about 80% multifamily. What is that saying, though? That the building permits that are being requested
Are you talking about
like 80% of them are to build multifamily? What does that say?
It means that they're building up and they're building
Renters. They're building for renters.
But do you know that though? Because that's the thing is multifamily, it could be condos.
I could break it down into
Could
the most specific thing, but it's a pretty safe assumption.
Well, yeah, like in there.
Right.
Yeah.
So what would that tell you? So if Houston and Dallas are starting to move toward that,
Then people can't afford to buy.
it's cheaper to rent.
Yeah.
And that's what, again, like you were saying, Casey, a lot of the market chatter, it could just be articles, are leaning toward that Dallas is becoming cheaper to rent, especially with the current tax property increases that are going on.
So another thing that I would say that might possibly point to and would require a little bit further of digging is, listen, when one market is possibly stalling or going down, it doesn't necessarily mean that the other isn't. So in terms of your niche, Single family and multifamily are completely different. So, if you're in single family, and let's say the market starts shifting, let's say your building permits on single family possibly start to go down.
Yeah.
Your competition's going to be higher. You might want to switch into multifamily
Absolutely.
during that time frame. And
Absolutely.
Jason Bible talked about this. What kind of insulated, I think it was Jason, who talked about, during a time when everybody's having fear, he's like, I'm just going to go into, actually, it was Michael Zuber, actually, who mentioned this. He said, I'm going to go into multifamily right now because the competition is incredible. Not a lot of people are lending here, but there might be people lending in multifamily because there's not enough activity. And
that's the thing, and that's where data becomes important. And again, it's always open to this could be broken down into endless things, like exactly what is a co-op in New York? Is that considered part of the multifamily building? Whatever it is, but this is like you said, this is a macro view.
But on this specifically, so say I'm a real estate investor, and that's an umbrella term, and I'm looking at this, I'm going, oh, there's more multifamily being built. Maybe I shouldn't be flipping right now. Maybe I should be buying and holding as a rental. Is that a safe deduction?
Yes, because if it's becoming too expensive to afford to live to own a house,
yes,
but you have enough to own a single family house,
you can rent it.
And again, and there's enough spread there. There's enough the rent, the 1% rule, whatever it is. Fantastic.
Yeah.
That's why the data is important. And again, it depends on your strategy. And now, if you're an investor, I think the one thing would be you would look down at the very bottom at that Anniston, Alabama, and you would go, oh, probably not going to invest there.
See, that's going to be my next question is like, if you're tracking these numbers and you see like in Dallas-Fort Worth it's 4,500, is this a monthly?
This is for January, yes.
Okay, so if I'm looking at it and then monthly was 4,200 and then February is 30 or 3,000 and then by May it's 1,000, that's an easy indicator, at least in my mind, saying, hey, there's probably a cooling off here. Maybe I should slow down on any kind of, I need to figure out what's going on first.
Well, yeah, and one of the things that you might want to look at, like say, for example, I'm using Anniston for an actual reason. If you go into that city and you look at the population over the past 10, 15 years, it has declined, maybe 10% each year.
Right.
Where with these other cities where you have these massive building permits, that you don't build housing for people if people aren't moving there.
And this is
whether it's multifamily or single family, you're not getting permits to build housing if there's no demand.
And I'm glad you brought that up because we were actually analyzing an apartment deal maybe a year ago, I think it was, and Ty was analyzing it for us, and he simply put up, there's only one, I forgot what city it was in.
Yeah.
But
I remember the name of the street.
Right, but the numbers is fine, but like there literally was only one for hire.
One job posting.
One job posting in the entire city.
And that's some of the things I do when I do analysis. I go and look for how many jobs are posted in that city.
Yeah, so that's one indicator I don't think we kind of put up, but that is something to look at because if you were to, I think Forbes just came out with a recent article that was talking about the top, 5 to 10 places to invest, and their indicators that they had put out were basically job opportunities or job growth versus your population, and so there is obviously going to be some weight there. Now, you talk to. A lot of people always say what comes first, right? Do you build the residences and they come? Well, you're going to be pulling the permits and building if industry is good and things are increasing. And of course, you're going to want to build because you're anticipating more people.
And you can get extremely granular. I know we love that word on this show.
Love it.
But like, you can go as far as say, okay, if I'm going to be doing a multifamily project, and depending on the economic, socioeconomic demographics of that area, how much work is walkable? Like what's walkable? Obviously, some places in Dallas that's an irrelevant conversation, but depending on what I don't know what the word is, rent rate or whatever classification, you want to make sure it's within walkable distance. I mean, if you want to get that grant.
And it depends on what kind of funding you're going to get. But the point of this, because if you're spending all day doing this, none of this is revenue generating activity.
Yeah.
But again, this is have this on your computer, pull it up maybe once. To develop your strategy and understand where you're going to go in 3 months or what you're wanting to do if you're moving into a new market. And, for example, I was kind of surprised, you go maybe fifth from the bottom, there's Tampa, St. Petersburg. Those areas have those are some pretty high building permit numbers. I didn't, and those are single family. Tampa, Petersburg, I wouldn't have thought that they would have had that much growth down there. I know that Clearwater is where the Scientology is headquartered, so
well, that's interesting.
Could be, but those have a lot of building. I mean, these are I pulled like the highest numbers of all the biggest MSAs.
Right.
And you look
Right.
at Phoenix, which is right under the Washington, D.C., it's 84% single family, 16% multifamily. So again, if you're in that market, that tells you something. It hasn't become a Dallas or a Houston yet, where renting is more affordable than buying.
And I'm glad you brought up the whole. I'm just so glad. I keep saying that over and over this whole episode.
I'm glad you're glad.
I'm glad. Thank you.
And I'm glad that you're glad that he's glad.
There we go. We're all glad. But talking about the revenue generating activities, and the thing about that is in real estate you need to be a student of the game. And yes, this may not be revenue generating, but this could be like, hey, you don't lose your ass if you understand what's going on.
This could be revenue not coming out of your pocket aiding.
Yeah.
Yeah,
whatever.
and this
I mean,
can be something when you have a spare time, when you have spare time and you want to like go to the TV, just pop on and just look at some of this stuff, because this is what's going to set you apart from the people who are sustainable in the market, no matter what it does, and who don't go into this industry with the fear of something happening or changing that they're not aware of. Because like you said at the very beginning of this, like data and knowledge is power, and having that in your back pocket is always something that you should do. If you're building a business, y'all need to know what market you're doing.
What's the next slide?
So anyway, and something I think that something that I just wanted to touch on, because I think it kind of flows from that conversation, is, you know, there are some things that you can do off of that. Meaning, if you're seeing all of these building permits, you might be wanting to ask, well, how many single-family renters are there even in a zip code or something like that?
Absolutely.
So if you're going to be marketing, it actually is a money-generating activity to do this sort of thing. Because I mentioned to you, I said, actually, it was Michael Corals who had a podcast that went into detail on this, and I thought it was brilliant. So I just wanted to very quickly share it. Is that when you're thinking of marketing to a certain area and you want to be strategic there, you're going to want to not waste your marketing dollars, right?
Correct.
Right? That's a huge deal,
Huge.
especially when
That's
it's
a
competitive.
gold nugget.
So a few of the things that he had recommended to do. Do I get the huge gold nugget? Thanks for the pity nugget. Is one thing that they do is when you're looking at a zip code or a certain market, you're going to want a population large enough to sustain, you know, your activity. So a good marker is about 250,000 or more.
Okay.
The second would be, you know, looking obviously at interest rates according to current, you know, PITI, lending rates, things like that. And there's a reason for that. You're going to want to look at your rental market within that same zip code. Then you're going to look at the total number of single-family rentals that are in a particular zip code. And then you really want anything from 1,000 to 10,000, because you want enough single-family rentals to warrant you getting something back, so to speak. And then what you're going to do is, out of that number of single-family rentals, you're going to be looking at the number of foreclosures, what percentage of those are actually in foreclosure, how many of those didn't get auctioned, that the bank took, so REOs, real estate owned from the banks. And then you're going to want to possibly take all of that data and look at who has that, you know, 30% equity or more. Now that can change according to your market. We say 30% here because 70% minus repairs is the ideal, right? So you want to have enough equity to do something should you get somebody willing to sell. And your days on market, of course, are important because a market can shift very quickly. 60 days, personally, for me, is kind of what I like, that average, and not a lot more, because a lot can happen. And then if you're looking at the median sales price, if you take all of those things and stack it in a zip code, the reason for doing that is that you're going to be able to anticipate if you can't sell that property, if there's a shift in the market. Let's say you're trying to wholesale it, wholetail it, any of those things, you're going to want to know that if you turn it into a rental, you're not going to be stuck in a hole. That's why all of those factors are important, because you have to have a different exit strategy.
Exit strategy more than one.
Absolutely.
Right.
And so that's a lot of information, but...
And you said it was, I'm sorry, Michael Corals?
It was
Spell
Michael
that, please.
Corals. It's Quarles. He had a great little podcast that just talked about that, and then he went into, you know, how you approach them. I will link
Michael
it.
Corals.
It's incredibly a great thing to read, because you're going to want to know that if you turn it into the rental, you can sustain it, accounting for all of those factors. So
Absolutely.
That's a really good way to just kind of target your more niche, and that goes back to looking, okay, well, we see all these building permits. What is my population that I'm working with?
And I'll put all that in the notes that you're talking about.
And speaking of the notes, I'm glad. I'm glad you
Okay,
brought
go
it
ahead.
up. This is obviously already a very note-heavy conversation.
Yes.
So you can get all the notes of this show and all the shows if you go to propelio.com/rewind and just drop your email in there. And what we'll do is every Friday or Saturday, whenever we get the notes done,
Whenever I get them finished.
we'll email those out to everybody that signs up, and that's basically what that's for, is just so you can get the email of all the notes. Before we get into the next slide, we are going to take a short break. But again, go to propelio.com/rewind, sign up for the notes, and we'll get those notes to you. Hopefully, if you have any questions, drop them in the comments. If you're liking what we're doing, drop them in the comments. If you don't like what we're doing, give us a like, subscribe. Regardless, it's free. Who cares?
Do it
All right,
anyway.
We'll see you in a little bit. The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at Propelio.com.
Hey everyone, welcome back. We're talking about an interesting topic to me anyway, but it should be interesting to you because this is going to be important in your strategy. We're talking about leading indicators and kind of looking at the health of a market so that you can be better informed on your strategies, whether it be marketing, exit, all that good stuff. So we were, just to really quickly recap, we're looking at 3 leading indicators and then stacking data on top of it. And the 3 leading indicators being building permits, housing starts, and new home sales. And then we're kind of layering some data on top of that.
Yes.
So let's jump right back in.
Yeah, so we went over those. We went over the 3 that we stacked there, and these are just some sort of ancillary, additional things to look at, to take into consideration. And you had even mentioned this, that the stock market, and specifically the S&P, which has some housing-related market stocks in it, it's also gonna follow along with the line. As you can see on we have a graph up here, and it's got like smart money. What in economics, what are called smart money, are the people who are investing in stocks because they know what's going to happen with that stock. They get the information before me, you, or any other person is going to know it. And so they're smart. So if they start, if house prices start to slow, if they start seeing this, it's going to be reflected in the market itself. And you can see here that is the graph up there? Yeah, the graph's up there. Sales, house price sales, sort of fall in line with the S&P and our other indicators. It's sort of, they're falling in line. And I mean,
I think something good to point out about this, to understand this very simply, is that a stock market is purely the expression of traders' opinion about the market.
It is, yes, it's the expression of the chatter.
Exactly.
It is.
So you might hear a lot of people say, when I start hearing about it, it's time to get out.
Yeah,
right?
It's too late. By
That's
the time
really
you
common.
hear that, yeah, it's too late. Because again, that's what I said, smart money. Warren Buffett is going to know what to buy before any of us would ever hear about it, because it's not insider information, but basically kind of that's what it is.
Well, he's looking at this stuff.
Well, they look at this stuff, and guess what? So you don't have to necessarily be them, just look at what they're doing. Again, the McDonald's, Burger King. McDonald's gets a location, and Burger King says, oh, must be great for a location. So they put a location there. Same thing. Our indicators, and then the S&P, they fall in line, and then the sales are kind of right in there as well. I mean, you've got to, so again, it's not just about looking at the S&P. That isn't going to tell you anything just looking at the S&P, because again, it's volatile based on people's opinion, thoughts, what's going to happen.
Exactly. If a trader thinks, and we actually did in my former life, we did a lot of analysis on how investment objects in the stock market were actually talked about in media. And we found that when it reached a certain threshold of chatter, it's when it started to come on people's radar, and then they started to have opinions about it. So when traders start thinking there's going to be a boom or a bust, they're going to start either selling or buying in real estate related items. That's why you see that it starts to fall in line. When it starts to fall in line with the actual building permits and other data is when you know something's going to tank, because they are going to drive the opinion of the market. But it is a reaction.
Yeah, and these can be buyers. These can be stock buyers from China.
They can be.
I mean, they're researching the housing market in the United States better than probably most of the people in the United States, and they're buying. They know when something's going to happen. And again, the importance of this is don't just use the S&P by itself. It's stacking the data. It's putting it on top of each other and understanding. And again, you don't want to get like 50 different graphs and be like, this is the exact point. Although I'm sure someone has probably,
right,
because they literally have predicted that the fourth quarter of 2019 is when there's going to be a housing bust or burst, whatever it is. So
you're talking about
almost
stacking.
Foreboding.
Like, in what way? I mean, is there? And this is a dumb question, but I'm asking anyway.
No question is dumb, Ryan.
Thank you, Casey.
No question is dumb.
Is there certain indicators when you stack it together that's like the black box? That's like, hey, this is the perfect situation.
If someone knows that, they're probably not giving it away. And again, what I think the point of this is we're kind of giving you an overview. We're kind of giving you, again, a 30,000-foot macro view of this. You may have something out there like Casey, you did the media, how the media impacts the other things. So that's something that you know about. So you have the resources to go and look at those indicators that might tell you, okay, is there a fund that follows this, that does this? Is there some sort of metric that measures whatever?
Yep.
You could then stack that on top of here and say, oh.
Absolutely.
And then you could do a historical stack of that data and say the last time that happened, here's what happened. And that's the value of this.
Exactly. You can use history. We tell you to do the same thing when it comes to lead sources. What do we tell you? The best leads are the stacked leads that cross multiple types of motivation, like they're in foreclosure and it's a probate. I'm calling that person.
And they're out of state or so, whatever it is. Yeah,
exactly.
This
is the same thing.
Yeah, it's the same thing.
And we're just pointing you in the direction of some things that are pretty hard to argue with when you're looking at the historical trends of that.
And if you come up with the data that is perfect, drop it in the comments.
Yeah.
And one thing I was just thinking about is like if you're new to the business and you're working on that first deal, a lot of this may be like, well, why the hell should I even worry about this? I'm just trying to get a lead. I'm trying to get a deal.
Sure.
And that's fine, but you still need to be thinking ahead, because when you're on your 5th deal, your 10th deal, your 100th deal, like if you already make it a habit and put this in your daily or weekly or quarterly routines, when you do get to that point of scaling, it's already secondhand. It's already a habit.
Absolutely.
As all the shows have said, you want to go into this business to build wealth, not create a job.
Yeah.
So a business has a strategy, has a plan from day one. You understand that.
Shout out to Ellie Gold, who we interviewed.
I love her.
Act as the person you want to be a year from now, today, not like strive for those goals. Just what is the person you want, your goal version of you, what are they doing on a day-to-day basis, and implement that today.
Absolutely, absolutely. And that's your business, guys, your business too. You have to put these things in place. What I always say, are you building a hobby or are you building a business? And this is one of those components.
Right, and I'll tell you, and any CEO, any high-level executive, this is what they're doing.
Yeah.
I mean, this is what they're doing. Now, they may not be for buying houses, but they're going, what do we need to do for our business? What is a strategic move that we need to take for our business? So on the next slide, we just have yet another layer that you can kind of go. And this is ETFs, or exchange traded funds, where basically they'll get together like if you had everybody that made water bottle companies, because you want to know what the water bottle companies would do. They'd get them all together, you trade them, that's a way to invest. XHB is a home builder fund. So it's an exchange traded fund where like KB Homes, Halvnania, whatever, some of the big builders are. So that's basically a way to get in, it's a spider fund. You get in, they're grouped together. So when these home builder funds, and again, it makes sense when you think about it. What happens if home builders, the stock price of the home builder fund starts to drop? What does that tell you? Just what does that tell you?
They're not building as much anymore.
Okay, right. And again, but it's based on, stock prices are mostly, they're not based on inventory of the company.
They're
just
based
on
sentiment.
chatter.
Yep.
Yeah.
Public sentiment. So again, this is, you could get all of this data out and figure out how much of the chatter is important. But yeah, when home builder funds start dropping, there's a reason. They're not building homes. And again, so this is just another one. You don't have to keep stacking and stacking and stacking. It's just we're adding other ones that you can look at. Again, none of these are looked at by themselves. But this one I think would be a pretty clear tell if
of what the market is doing.
Of what home builders are doing.
Yeah.
So, you know, the home building market specifically, what is it doing? Now that has nothing to do with sales of houses, because not necessarily every house that's sold is a new build.
It's going to have to do with for other indicators on
Absolutely.
actual housing permits that are going to be requested and granted is going to be based off of this. So, you know, that just goes to show you can pinpoint where the supply and demand cycles, you know, when it's going to ship.
So all this information is together, tells you something. And then the next slides we're getting into are, they're not complicated, but this is I think where the panic is coming.
If somebody says it's not complicated after we've had this in-depth conversation, I feel it's about to be complicated.
No, what I'm saying is, because I've seen this mentioned, and I don't know if you've even heard this mentioned or heard people talking about an inverted yield curve or heard that coming up, and the panic about it.
Every time it happens, a recession happens.
Well, that's true.
Every single time.
And that's true.
But how long have they been doing that study of the inverted yield?
Since 1642. I don't know. But
I was like, whoa, how did you know that? Well, this one's a really simple concept when you break it down into this. We all know that interest rates in a market are going to determine basically how much banks are lending and not lending is obviously going to affect how people are able to, you know, get lending to build and to, you know, rehab and to purchase
everything.
And to do all of the things that happen in a market.
Yeah.
And so, you know, when we talk about like market liquidity and we talk about these curves that happen, it's pretty simple, right? The bank is Fannie
Mae and Freddie Mac.
I cannot talk today. Exactly. They're going to lend right to people based on certain things. They're basically going to buy short-term paper.
Which are short-term papers like money good. It's a U.S. Treasury bond, which is the same as cash.
Exactly.
Very, very low interest rate for the bank to borrow it.
Right, for
Short
them
term.
to borrow it, right? And then they're going to give it to you at a certain rate, and the difference between what they borrow at and what they lend at is going to determine how profitable the bank is.
Right, that net interest margin. So what they borrow at short term, they lend out long term, say a 30-year fixed rate. That spread is their net margin. That's how the bank makes money on those.
Right.
Okay, and just like you're saying, what if that spread starts getting smaller and smaller and smaller? Banks start getting less and less and less profitable at lending money.
Right.
And so that decreases the liquidity in a market. So what happens when that yield curve, which the market liquidity, that's the yield curve is what's happening with those spreads.
How much is being lent out at a time, correct?
Right.
That's what we're looking at.
So yes, and then so basically in the next slide kind of puts on top of that house prices. So house prices since 2000, since the dot-com burst, house prices have moved inversely in relation to the yield curve, meaning opposite. So house prices, if the yield curve goes down, house prices go up. So if interest rates, and it's like, you know, if interest rates get smaller and smaller, lower and lower, what's likely to happen? People are able to get money. They're able to borrow money because the interest rate is so low. So they're going to buy more houses. When people are demanding more houses, what happens to the price of houses?
Goes up.
They go up. So that's why it's inverse. However, when it becomes negative, or that spread, that net margin that the banks make in order to lend money, if it becomes zero or negative, they're not going to lend money to people. So then what happens? Now, the yield curve is going negative, and I believe it's been negative for a while. So but banks are still lending money. So the only thing that keeps house prices going up is the fact that they are lending money. But they can only do that to a certain point, and they hit their breaking point. I don't care how many people want houses. If you can't get money, there will be no demand.
And this is an obvious statement, but I'm gonna throw it out because I feel like that's my role here at Propelio TV is obvious statements. You know, Troy Fullwood last week, he was talking about how what's the biggest building in any city, and that tells you what's important. And usually it's the bank. Banks are in it to make money. So if a bank ain't gonna make money on your loan, they ain't gonna loan you any money.
Well, they can't.
Right.
Yeah, and something interesting, and I have two things to say on this one that I think is interesting because I read recently that housing prices are actually 30% higher than when the last housing bubble burst in 2007. All that tells you is that a lot more money is being lent out because that increase is still occurring. One speculation I heard from somebody, and y'all feel free to jump in, is that the reason that they're still increasing, even though we're noticing that lending starting to pull back a little bit, interest rates are kind of starting to go up, is that we still have a higher percentage of cash buyers in the market than we did in 2007 and, you know, in that range. And if you have your cash buyers, they're not dependent on the lending, which means they can still be investing in the economy, and that can actually create a buffer. So it just goes to show you that when you're only looking at this and the bank rates, you might be missing out on that one piece of the puzzle, especially in a particular market.
Right.
And you can pull up that info on Find a Realtor. They'll tell you where the cash
and
buyers
also,
are.
again, this is a very broad view. This is not Dallas-Fort Worth particularly.
Right.
Again, every sort of, even within Dallas-Fort Worth, you could say, look at the M streets. That's going to be completely different than, so the more hyper-local you get, these things matter. These are strategic, but you have to understand your market as well. I mean, you really need to do this market analysis for your own specific market. But yes, if there are people buying, there's always going to be a demand, no matter how they get the money. The point of this is the agency money, the Fannie Mae, the Freddie Mac may not be available. Those would be typically the end buyers. There may be a ton of people who are lending hard money for people who are doing buy and holds.
Exactly, and so wouldn't you say that's why you might hear, if you're in real estate, you might hear a lot of people say, I'm stacking cash and waiting for that to go down, because when you have less institutional money, that's when you get some deals, right? Because there's a smaller pool of buyers.
Right.
It called back to like the first 2 minutes of this episode where you talk about how it's markets up, markets down, doesn't really matter. It depends on what your strategy is in this game.
And investors win either way.
Yeah.
Yes.
If you're an investor, you win either way. And again, if you have cash built up and you're going to be able to lend to somebody, it's very important to know this. It's very important to understand this kind of, hey, okay, when are the banks going to stop lending? What's going to happen?
So before we move on, I do want to take another break. Before we take a break, I do just want to give a couple shout outs. Yes, Annie, Batch Skip Tracing, this is your shirt. Thanks for watching. Joe Johnson, he brought something up in the YouTube comments very early on, and I love it. And it's I don't know what he was referring to, but it's the normalcy bias. And you being our resident economist, can you define what that means?
I won't have to look it up. I don't know what he's talking about.
Oh.
I'll have it when we come back from the break.
I assume it could be something along the lines of like a bias towards what you think is normal or trending or something, but that might not be the case.
I think that's my favorite answer ever.
I totally
what about prognostication?
Prognostication?
Just people like prognosticating?
Cool, I don't know.
Literally, somebody in the Facebook, I think it was
Maybe
Andrew.
we should have them come on the show and teach us, because I don't know if that's a thing.
That was
like a prognosis.
Market prediction.
Yeah. Okay.
He says, "Don't you guys, gal, dare in this without a prognostication of some sort." So anyway, we'll go Google all these words, just like.
They basically want us to give them some sort of, indicator of the market.
Yeah. But we're going to take a break. Yeah. We'll come back after we've Googled some of these words. The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at Propelio.com.
Yeah.
Hey, everybody, thanks again for watching. So far, if you've watched this long, hopefully your brain has melted just like mine, because we've talked a lot about the different market indicators, why stacking these indicators matter. Also, again, shout out to the Rewind in the Rewind notes. Go to propelio.com/rewind, and we will email out these notes for you. Because episodes like this, when it is data rich and data heavy, there's only so many times you can watch this over and over and over. I would love for you to do that, but get the notes from us so you can actually have something to get back to. I can't talk like you. Anyway.
So who was it that brought up normalcy bias?
Joe Johnson.
Joe. Okay, so we looked that up. We're that smart. So basically what that says, normalcy bias basically says that when people expect or believe there's going to be a disaster, they don't prepare for it adequately because they believe that things will always function as normal.
Right. Well, that's the opposite of what I said.
Well, I mean, but again, you have situations of both.
Yeah.
So again,
yeah.
If you want to look at it like that, well, it's going to get back to normal. Yeah, sure, there may be a market bubble. It's going to get back to normal. Guess what? It is always going to get back to normal.
Yeah.
But in the short, and that's more of a long view, a long-term view, the normalcy bias. But to be honest, I don't think people think. We're talking about things that, like most people, and if you're an investor and you're paying attention to a lot of this stuff, you're really into data. I think most people are more concerned with, like, are one of the Kardashians having a baby? You know what I mean? Like it's most people.
They?
I don't know. Is that a show, Kardashian? I've heard of that. No, but if you're really paying attention to this, and again, the data, they call it analysis paralysis.
Yeah.
That's not what we're promoting here. We're promoting preparation for strategy for if it does fail. What are you going to do to make money when it does? Mm-hmm. How are you going to come in and be a lecherous investor? No, I'm just kidding. No, but how can you help people? Like if it comes in and house prices start crashing, people start losing, they can't get their money, they can't save their house. You're going to know that's going to happen. You're going to be prepared as an investor, and we're hoping that the normalcy bias doesn't dampen your action. In this case, that's all that we're hoping. And as far as prognostication, we'll say something at the end to foretell maybe what's going to happen in the future.
But it all depends.
Right, it all depends.
So let's finish up the presentation itself.
Yeah, there's one more thing that I think people look to that might mistakenly think that this is a lead indicator, but kind of the data shows us that it's actually a lag indicator. It actually responds to the other ones.
Yeah, the commodities.
The commodity prices. Yes.
Yeah, like housing-related commodities like lumber. These typically will lag behind because in terms of price. So like house price will go up, and then the price of lumber like crashes. Well, why is that? Well, because again, house prices went up, and with all the other data we stacked, it caused a, let's say, crash or a dampening of the market or softening of the market. Then nobody wanted lumber. People couldn't build anymore. There was no more building. The house builder fund went down. So lumber's kind of behind that. But again, if you watch smart money and they start shorting these commodities, they know. There's a reason they're doing that. And I'm talking about people in China, people who are really big money investors. They know. The institutional investors, they're aware of this. You can kind of watch for that. Again, don't get too caught up in it. Basically, what you need to do is do cold calls, drive around, driving for dollars, all that stuff. But these are more for the macro view, like the strategy, the strategic.
So on this one in particular, I mean, I would say that this is kind of the nail in the coffin for housing prices. When you see the lumber prices fall, because they tend to fall after the peak of the housing prices. So when you see that lumber commodity fall,
and this is from yesterday. This is the lumber commodity price from yesterday. So what would that say to any of us? I mean, this says to me, okay, maybe there's not as much demand for lumber because again, when demand goes down, price goes down. So
is that a long-term chart on the bottom there? Is that long-term? Pardon my eyes, and I can't read. That's just
March to May.
Okay,
so
gotcha.
over 3 months, what does that tell you?
It's dropped 100. Is that $100?
Let's see.
Or 100, whatever the unit is.
Say 410 to $100 about.
Okay.
So
That's
what
a
is
fourth,
so what does that
20,
tell you?
20%, 25%.
So what is that saying? If we just said it's a lagging, not a leading, it's a lagging indicator. It falls after house prices peak. So then what's going to happen to house prices?
They're going down.
Foreseeably going down.
Okay, so that's our prognostication. We're
Done.
taking the price of lumber, and we're predicting the price of your house next
Today
week.
on Propelio TV, we learned that lumber can determine what the market does.
Hey, I mean, look.
But that doesn't necessarily mean that
'Cause
it's
it
going to be a
depends.
huge
Again,
crash. It doesn't
no,
necessarily
and
mean that.
Again, there could be a glut of lumber. I
And
know
again,
there's not, but I'm
this
saying
is a global price of lumber, right?
yeah. So
And again, you need to determine your market you're talking about, because, like I said very early on, when the whole shit hit the fan in 08, South Lake saw barely a blip. I think actually South Lake prices went up. So you got to remember what your hyper micro,
right.
hyper local market is to determine. So again, this doesn't. It depends. It just
no,
depends.
and again,
We've
with,
covered.
right, like the
We
like
know.
the
Basically,
submarket
the answer
deals.
is there is no answer.
Well, again, no. Long view, 30,000 macro view. You doing your deals every day. What you're doing, figure out what works for you. But insulate yourself, Casey. Like you were saying, the quarrels. The guy quarrels. He was talking about here are the things to do. Days on market. Again, if you have multiple exit strategies, if you understand what the market is going to do, and there's no guarantee. I mean, the price of lumber could skyrocket tomorrow for some reason. There could be some insane shortage of lumber because every forest in the world burns down due to the comet that's crashing our way.
This got dark really fast.
Right, whatever. But so don't put all your eggs in one tray.
Yeah.
But will there be any eggs if all the forests are gone?
Who cares?
Okay,
So,
we're gonna wrap this.
But the point is, these indicators.
Yeah.
Never fear data. Never fear the data.
And I'd be curious at how many of you really thought to look at these things in the comments. Like, are
I've
these?
never thought about lumber.
Well, you should. Well, yeah. I mean, but it's a huge thing, right? We
Yeah.
need it to build things. And here's another thing too: is like, some markets might be more heavily dependent on that versus other building materials. So
Home Depot, Lowe's stock prices.
That's true.
What Caterpillar?
Yeah.
I mean, think that think of those things. Where would you get building supplies? What things would go down in a crashing market?
Yeah, exactly.
Building supplies, reinvestment.
But I could see
that's
now
part
that
of GDP.
after hearing some of this stuff, like, I know you never want to have analysis paralysis. There's so much data, and yes, you want to stack, but on me trying to find maybe not the easy way out, but just trying to find the most efficient way to get as much data as possible. Maybe it makes sense to every morning before I hit the streets to drive for dollars, what's lumber prices?
Or
just
look
to get the macro view of
or
it.
what would you say
quick
if you had to
macro view.
choose one? If you had to choose only one indicator to look at every day,
Only
one.
I mean, honestly, I would overlay the three first and foremost. Honestly,
So
you
you think that's impossible to do
I
just the
think that
one?
if you were to only look at one, you're probably going to be steering yourself in a direction that might not be very strong. So I would say
Right.
at the minimum, I would probably stack the original three
Which are?
indicators, which are
Sales price.
which would be one, the amount of
Building
housing permits that are being
Permits.
permitted. How many of those builders have been started? Because there is a metric for that. You can see how many started. And then third would be the actual sales price.
So permits, starts, and sales.
Yes, I would say those and new home sales. And maybe this is something I could start doing if you follow me on social media. I might be able to
Look at her
do this work for you.
Permits, starts, and sales.
And maybe kind of play with this a little bit because I find all this very interesting.
love
And
it
I think
too.
it can
Yeah.
really help us. Gosh, somebody told me the other day, oh, you're an investor in Dallas, and I'm fairly new to the game. And I always joke with my husband, if I can make it in Dallas, I can make it anywhere because it's so competitive.
If I could make it there.
Dallas. But it is really competitive.
on.
And people think there are no deals. Why are they in their head about no deals?
Right.
Maybe their marketing's not working, maybe not. But maybe they're looking at the zip codes wrong. Maybe they're just trying everywhere. Maybe they aren't focusing on less competitive areas. And these are all things that you guys can do.
All the data's
if you're
available.
feeling stuck, try something new. Go look at some of these things and kind of get a feel for what might work for you.
And ultimately, this entire conversation we had is also relevant because if you want to feel smart at a networking event, You pull this shit
True.
out of your ass.
What do you
People be
guys
like,
think about
"Oh."
market liquidity? And then somebody goes into blah blah blah. You're like, oh, I didn't study that much.
yeah.
And you could be a value add to somebody, because let's be honest, not everyone is as nerdy as Tyler and I.
Right. I
And
love this. I
we
can stay
love
up all
this
night.
stuff, so come talk to us about it.
Glad I was.
Maybe we can
Basically,
help.
what you're saying is I'm the idiot.
Well,
in
you
the
know,
couch.
you said you.
That's what you're saying.
No, you like the
don't-
data. You
said
like
it's too much
data
work.
that you like. Like the data you like is geared towards you.
Yeah.
So basically,
He can't think of any data that I like.
no, YouTube
Oh,
data.
I know what data you like. YouTube data.
Yeah.
On your viewership, guys, that's what he likes to look at.
So therefore, you need to like, heart, subscribe.
all the
those
things. Well, if you find value in this, and this is something that, you know, even if you don't want to do it yourself, you might want to reach out to us. By all means, just like and share.
Yeah. So
It's all good stuff.
you just had one more slide with the Dallas County home sales.
Well, and that's it. Yeah, this was just. I just wanted to get a little bit local. I tried to make it more broad, but this
Yeah.
was just local, and the house prices. It's always been doing this. We see at the end of Q1 2019 right here, it's gone down. It dips a little bit. It always dips. It always comes back up in June. July is usually June and July are the peak. Pretty much of every year, every cycle, June and July have been the peak of the house price, and you can see this is since 2008, since the crash. It's the same. Like every year is the same. So June and July it goes back up. But again, if you look at the very end of this, it's trailing a little bit. It's kind of falling, but it's a little flatter than the other years.
Mm-hmm.
So again, if you stack this on top of the other indicators, what is it saying? You know, I mean, that's it. That's
Yeah,
all.
exactly. I can't read that far, so I'm like.
Oh, you can say that far. Basically, yeah, it's just saying the prices are they're sort of leveling out a little bit.
They are leveling out. And I think we've heard a lot of people say that. Of course, it was a ridiculous market the last few years here in Dallas. And so just because something's leveling out or possibly going a direction just might mean it's correcting itself back to an average. It doesn't necessarily mean doom and gloom is ahead.
and then even then, it's just, you know, I forgot what I was going to say.
No, but again, even if it is no.
Pivot
Again,
your strategies.
Yeah.
well, yes, but doom and gloom, you're talking about for a homeowner. For an investor, like if it's doom and gloom for a homeowner, if people start getting foreclosed on, that's a gold mine for investors. I mean, I'm not trying to put it in that kind of light, but that's what it is. I mean,
Right.
people
The
start getting
opportunity,
it's
yeah.
opportunity for investors. So I'm always like that. Whatever the data says, if the data said, "Oh my God, house prices are going through the roof, people are buying like crazy," guess what? That's amazing for investors. Oh no, people are losing their houses; they're getting foreclosed on. Guess what? That's good for investors.
Yes. And one thing I will say, I think that a good market kind of trains investors on bad habits, because even if if you think that this is going to last forever and you're just kind of making them like, not necessarily, you might not be aware, but maybe you're buying too high just because you're an eager buyer or something along those lines. When this market does correct and dip, you might find yourself in a pattern that's not going to make you survive compared to these other investors that look at the data. So I always say a good market makes bad habits for investors if you're fairly new and you don't consider any of this stuff.
So my biggest takeaway of this whole conversation is the importance of stacking information, stacking data. And I know we talked about how there's a gajillion other indicators.
Mm-hmm.
I believe Andrew was suggesting, what about pay and annual wage?
That's
How would
critically
you throw
important.
that in there?
Absolutely.
Because what would that say to you? Just Ron, what would it say to you if wages were going down? What would that say?
That if wages were going down, that means the economy is going down. Therefore, maybe less people or maybe more people are less inclined to purchase new homes.
Or people can't
or they
afford
can't
homes.
afford new
Right,
homes.
exactly.
And then maybe that's also a pre-indication or prognostication
Sure.
that foreclosures are ahead.
Yeah.
Right.
Yeah, and you can look up the number of foreclosures in certain counties. So Denton County in the last, I think, month or two has actually seen an increase in foreclosures, compared to some of the other counties. So that might be a correlation to that sort of activity. So you can kind of see a difference.
Yeah, the term you guys use, you can get as granular as you want. You can look at how many percent of houses are leveraged at what percent, how many people are behind on pay. I mean, literally.
Yeah, you
can
do
get
a
as
lot.
much data as you want. Is that going to lead to your next deal? Probably not, but it's a macro view. It's critically important to know that. Absolutely, if you find some metric that you think is a great indicator, wages in Dallas, the job growth is insane, but that doesn't mean wages are growing. Again, yes, so that's important. Any metric you think of anything, drop it in the comments.
Mm-hmm.
It's
Absolutely.
It's great.
And before I let y'all have y'all's last final thoughts, I do just want to say, if you did get value out of this episode, please subscribe to our YouTube channel. If you're watching on Facebook after we've wrapped up, just go to youtube.com/Propelio and click subscribe. Drop a comment, drop a like. That really does help it, as stupid as it may sound. For years, I've watched YouTube videos and all these people like, come on, give me a like. I'm like, no. Like, why? But after studying this stuff, it really does help. So if you've never given us $1, if you don't subscribe to Propelio or our paid service, don't worry about that. At least help us out by giving us a subscribe, give us a like, and drop a comment that, hey, you liked what we said, or Ryan's an idiot. Doesn't matter. Just drop a comment.
Don't say that.
Casey, what's your biggest takeaways, final thoughts on this whole
My
conversation?
biggest takeaway on all of this is honestly, when you're looking at some of the stuff and the data, or if you hear somebody talking about a crash or any of these things, ask yourself 3 questions. Where is the market strong? For who is it strong? Meaning buyers, sellers, types of investors, and again, for what kind of real estate is it strong? Rentals, buy and holds, wholesaling, listing, all of those different types of strategies are going to work in different markets in different ways. Mm-hmm. So I would say ask yourself those 3 questions, and I think you'll be probably far ahead of a lot of people.
Tyler?
My takeaway is permits, starts, sales. Like she said, it's always going to be hot in some market, and we're not asking for a like. We're telling you that you have to give us a like.
What is happening?
We're demanding it.
What's happening?
Mr. Pig says,
he's gone off the rails, y'all. He's gone off the rails.
What's funny is I literally was about to say, hey, if you liked this type of information, maybe we could do a monthly segment on economics with Tyler. Drop in the comments if you would like that, and then you immediately did that.
No, the point of that was there was no pork in that.
All
fact.
I see what you did.
I am dying.
So, anyway, Propelio.com. If you're looking for comps, if you're looking for comps, off-market lead lists. If you're looking for websites, Propelio.com. We are having a Drive for Dollars apps coming out right now or soon. We're beta testing all of that. And that should be full release fairly quickly soon. Our ongoing joke is 90 days, but it is what it is. And then we're also releasing national data 3 to 4 weeks. That's the last timeline update we've been given. So we're about to have national coverage of all our services in 3 to 4 weeks, hopefully like a month or so. And then our Driving for Dollars app in the next 90 days.
I'm excited for
Tyler,
that.
how can we get a hold of you if we have questions or whatnot?
Tyler@propelio.com. Swipe right.
I can't even. I don't even know how to follow that one. Are you done? Is that it? On that note, I'm going to probably be posting a little bit more of this stuff just because I really think it's interesting. So if you want to follow me on Facebook, shoot me a message first, please. Or Instagram, Casey Buys Houses. Any of those things, you can get a hold of me pretty easily. If you just want to talk shop, sell me a deal.
She's married, so swipe left.
So swipe left on me, please. Don't even put anything inappropriate in any commentary.
For me, I'm highly not married, so I don't know. Attention and attractive, that's all I'm looking for.
Anyway, thank you so much for tuning in. Is there anything else?
That's it.
Thanks for listening to us ramble about data.
Like and comment, people. Like and comment.
We will see you soon.
And Ryan. And Casey. And Ryan.
Propelio TV is sponsored by Noble Mortgage and Investments, Batch Skip Tracing, Think Multifamily, CreativeCashflow.com, and Life and Air.
Thank you, everybody, for showing up to the Propelio event. We had a great time. It's huge, as always. We love everybody that came. If this is your first event, jump on Facebook, jump on YouTube. Let us hear it. Let us know what your thoughts.